Well, good morning from London, good afternoon from Hong Kong. Delighted to welcome you to this webinar, an enabling regulatory framework for innovation, Web3 and FinTech. And it goes along with the report published today by ZEN, but commissioned by the Hong Kong Financial Services Development Council, looking at regulation, Web3 and FinTech. You're very welcome, and we look forward to the session. By way of introduction, my name is Mike Wardle. I'm the Chief Executive Officer at the ZN Group. My job today is to moderate the session, keep us to time, and to manage us through. Just a few housekeeping points. The program today is quite simple. After my very brief introduction, we'll have two perspectives from Hong Kong, from Sean Lee, co-founder and CSO, IDA, and co-chair of the Policy and Regulatory Subcommittee at Web3 Harbour, and Jonathan Gill, Senior Tokenization Director and Legal Advisor at the Hashkey Group. Following that, we'll have a presentation from Simon Mills, one of my colleagues, who's the lead author on the report we're publishing today, and then there'll be time for Q&A towards the end of the session. If you haven't used the GoToWebinar program before and you want to ask a question or make an observation, you can find the question tab on the dashboard on your screen. You can type in your question or your comment, and you can do that at any point during the webinar. So if there's a bright thought that comes to you, you don't have to wait to the Q&A session to get it into the system. We will be recording the session today, and a recording of the webinar will be available on our website in around 24 hours time. So if you want to go back and listen again, or if you have friends and colleagues who you think you might be interested in the content. That's all, I think, by way of housekeeping, other than to say if you do ask a question or comment, we will share your contact details with the speakers. So if there's a need for follow-up discussion or email correspondence, that can take place. So without any further ado, we'll move into our presentations. Our three speakers are prepped and ready to go. Sean and Jonathan are going to take the stage first, followed by Simon. Sean, over to you. The floor is yours.
Great, thank you very much. Just want to double check the slides are up on full screen mode.
All working, thank you.
Great, thank you very much. So I am very glad to be speaking with all of you today and share with you a little bit about Hong Kong's latest digital asset landscape, as well as some of the policy developments in the region, as well as things that are applicable into Hong Kong. One of the reasons why there has been a lot of activities happening in Asia from the perspective of Web3 development is that if you look at the latest Chainalysis 2024 Crypto Adoption Index, you will see that 9 out of the top 20 countries are indeed right here in Asia, starting with India right up top, as well as one that in the very bottom that might catch some people by surprise, and that is one of China. The interesting thing about China is that there is a common misconception about China banning the entire crypto industry. In fact, that is actually quite not true. China have obviously banned crypto trading and crypto mining, but in actual fact, crypto assets is still, in many cases, considered as legal property. So there is still lots of Web3 and digital asset blockchain-related developments spread across the Asia-Pacific region. And this is certainly something that we're continuing to monitor and continuing to see that are happening in the region. Now, some of the reason why that may be so, I'm sharing a few of these observations here as it relates to the region. So if you start on the top left-hand side, the Asia population is roughly about 60% of the world population. But the important aspect here is that the median age is roughly about 32 years old. What that means, though, is that this population generally is much more digitally savvy and very in tune in terms of mobile payment, digital currencies, as well as other forms of the digital applications. What you also see is that across the region, you do see a lot of adoptions around things like DeFi, which is decentralized finance, as well as using things like stablecoin as a mean of cross-border payment. In fact, that relates to one of the points that I have in the bottom left-hand side, as it relates to the largest trade agreements that is currently in the world today. That's the RCEP, the Regional Comprehensive Economic Partnership, which takes up roughly 1/3 of the world's population, as well as 30% of the global GDP. What that means is the need for more efficient, more secure, faster, cheaper, as well as safe ways of transporting and transacting across regions naturally becomes a high priority, which means that then the notion of things like stablecoin and digital assets as a form of payment, as a form of transaction, becomes very prevalent in the Asia Pacific region. Now, of course, usage and user adoption needs to go in line with the regulatory environment as well. In fact, Asia, especially places like Hong Kong, have long stand out as one of the more progressive jurisdictions in providing regulatory clarity for both crypto assets as well as stablecoin. And then naturally, along with that, there are also government-led initiatives, a lot of them centered around CBDC, that's central central bank digital currencies, with many different projects like Project Guardians as well as Project Ensemble out of Hong Kong. So these are just some of the general observations in regards to why there seems to be an increasing growth as well as high adoption from a crypto and blockchain-based finance perspective. Now, I typically share the slides. I know this is probably quite an eyeful in terms of information, but this is much more of a snapshot around things that are happening. And as you can see from the summary here, there are indeed a lot of policy-related activities all around the region, especially given some of the larger jurisdictions that tend to be financial services hub. Now, that leads us into talking about Hong Kong. Now, Hong Kong, as many may not know, back in the 2015-2016 age, Hong Kong was indeed one of the leading crypto hub in the world in terms of both activities as well as companies that have set up in the city as a starting point to run their crypto business. Now, there were a number of years where that crypto hub kind of nomenclature has decreased based on kind of regulatory guidance. But back in 2022, roughly about 2 years ago, there were a series of announcements coming out from both of our regulators and policymakers highlighting Hong Kong's arrival as a digital asset hub. And you can see from this particular slide, there have been many activities, many circulars, and many guidances, both in relation to virtual assets as well as stable coins and authorized funds that are denominated in crypto assets that have really enabled Hong Kong to take the next step towards that becoming that global digital asset hub. Now, this is becoming quite friendly, and as we have seen over, that those of us that live in Hong Kong over the last 2 years, many of the conferences have attracted some of the largest players in the world from a crypto and digital asset perspective to come to Hong Kong, either to set up an entity, set up a business, but as well as attending various different conferences that we have holding, including one coming up next week, which is Hong Kong FinTech Week. Now, diving in a little bit in regards to some of the latest developments from a policy perspective, the Hong Kong government actually outlined 2 very important policies at the end of 2023. One was in relation to the authorized funds that can hold digital assets, which then became the impedance for Hong Kong to actually become the second jurisdiction in the world to launch Bitcoin ETF. So that happened earlier in the year. The other important aspect is actually around the stablecoin regime. Now, as you can see on this particular slide, Hong Kong is actually one of 6 jurisdictions in the world that actually have a defined stablecoin regime. Now, when I say defined stablecoin regime, these are actually indicated and structured as stablecoin, not some other forms of digital assets or crypto assets, right? So this is very specifically written as stablecoin. So you can see on this slide, from the European Union perspective, that's the MiCA regime, the UAE from the central bank regime that talks about the dirham-backed stablecoin, Japan and Singapore, and then obviously leading into Hong Kong and the UK. Hong Kong is actually near final in regards to enacting that into law. our regulator here have been very progressive in making those announcements, as well as the timing pretty clear to the industry. And we're going to be seeing a lot of flexibilities and a lot of very interesting aspect around that stablecoin regime that would distinguish Hong Kong away from potentially other jurisdictions as well, including the notion that our stablecoin regime actually does allow for multi-currency issuance under the same license, as you can see on the right-hand side, as well as some a very progressive move in regards to the capital, the share capital requirements that distinguishes Hong Kong's regime versus others. So all in all, the Hong Kong jurisdiction very much understands and appreciates to be a global digital asset hub. You need to have various different components that makes up the digital asset industries, both from a virtual asset trading platform perspective, as well as from a stable coin, and then also moving into the future, some aspect of the OTC side of the business as well. The implication for what that means in Hong Kong is actually very, very important. And I've highlighted that in this particular slide, indicating the regulated entities within Hong Kong, whether that has to do with the financial institutions or Hong Kong-based businesses, but as well as the Hong Kong residences interacting with overseas and in terms of cross-border payments. A lot of these interactions that are already in existence can be further amplified with a regulated stablecoin, both in terms of domestic business payments, but as well as, more importantly, the cross-border and international trade aspect as well. So it is quite important for Hong Kong to have a very defined fundamental stage in regards to where some of these policy developments are that can then enable a lot of the things that we talk about on the right-hand side, which is obviously increasing the uptake from a financial institution perspective, wider acceptance by the merchants, both here domestically as well as internationally, but then most importantly, creating a greater adoption for customers here as well as abroad. I'm going to perhaps end with this slide and pass it to the next speaker as well to dive much more into the virtual asset trading aspects. But I want to leave you with this slide. I do have a podcast that I run on LinkedIn that highlights a lot of the Asia development in regards to digital assets and policy updates. If you're interested, please do follow me there, along with various different other channels that we have sharing about Asia policies. Thank you very much.
Thank you very much, Sean. And I'm going to pass straight on to Jonathan Gill to give his presentation. It's all looking good, Jonathan. And you're just muted at the moment.
Right. I'm Jonathan from the Hashkey Group. So I'll be talking about three topics essentially. Firstly, where we've come from. So how Hong Kong's Web3 and FinTech ecosystem has evolved from both commercial and regulatory perspectives. Secondly, where we are. So how Hong Kong's environment has shaped the decisions that we, Hashkey, have made as a business. And thirdly, where we're going. So that's how we think the optimal design of an enabling regulatory framework should be. So to start off, in no particular order, this is just in terms of the alphabet, Binance, BitMEX, Crypto.com, and FTX were all actually founded in Hong Kong. So when these businesses were founded, Hong Kong didn't really have a virtual assets regime. It was just a financial center, as it still is. And then all of these crypto businesses sprung up. Hashkey itself was founded in 2018. But I guess unlike these four businesses that I've just mentioned, we've really had a focus on getting licenses and being and having a sort of compliance-first culture. So I think that's the commercial landscape. So from the regulatory perspective, there are a few things I'd like to highlight. which is quite similar to what Sean's mentioned, but I'll try and go into these in a little bit more detail. So firstly, in 2019, for security tokens, the SFC said all security tokens are complex products, meaning they cannot be held by retail investors, so professional investors only. So that was 2019. Then, as Sean said, in 2022, we saw sort of a maturation and an acceleration in terms of regulatory acceptance of virtual assets. So we were granted Hong Kong's second virtual assets type 1 and 7 licenses, which means that we were given a license to essentially be a broker-dealer, deal in securities for virtual assets, and then an ATS license, which is essentially to run a virtual assets exchange. Then in 2022, late in the year, the SFC came up with what they call the same business, same risks, same rules mantra, meaning that they would regulate virtual assets on the same basis as they do for traditional securities. Now, that was a good thing because after just saying that all security tokens are complex products, no matter what they are, we saw that as a maturation and a growing acceptance that virtual assets are better understood and more widely held by the Hong Kong community. Then in 2023, the Hong Kong Monetary Authority launched tokenized green bonds. So that was an $800 million issuance to institutional investors only. And that was a 1-year 4.05% fixed yield bond. Then we were granted Hong Kong's first virtual asset trading platform retail license. So, all of this stuff until now was professional investors. Now this is again a good thing because it's more open to retail investors. Then 2024, we listed Hong Kong's first Bitcoin and Ether exchange traded funds on the Hong Kong Stock Exchange. Now that was a milestone in that Hong Kong investors were then able to gain exposure to Bitcoin and Ether without actually having to hold them themselves. So they didn't need to hold wallets or anything like that. They could still they could just invest like any other ETF on the Hong Kong Stock Exchange. And then the HKMA much more recently this year launched Ensemble, which is a real-world asset tokenization focused infrastructure project. And then Project EHKD, which is a wide range of projects focused on a CDBC range of use cases. Then the chief executive has, in the last week, announced a few new measures. So right now, the Hong Kong Monetary Authority is testing CDBC tech solutions and use cases for cross-border trade settlement, which I think is an important thing because obviously there's a real opportunity for trade settlement to occur in CDBCs. Probably not so much for retail, given that how convenient it is for Hong Kongers to pay, with things like Octopus cards as a stored value facility, credit cards, cash. You've got the mainland payment mechanisms such as Alipay, WeChat Pay, Union Pay, and so on. So I think the opportunity is going to be in cross-border settlements, and they've recognized that too. Now, the FSTB, the Financial Services and Treasury Bureau, is now completing public consultation about a over-the-counter VA trading, and is going to propose a VA custodial regime, which is probably something that is a bit of a missing piece in terms of virtual assets in Hong Kong. And then lastly, the Hong Kong Monetary Authority is going to launch a digital bond grant scheme to encourage capital markets adoption of tokenization, following on from the tokenized bonds measure that I talked about before. So what this means in terms of the regulatory environment, I think there's a few key issues here. So firstly, the sector, as I've said, is becoming increasingly regulated, right? So the entities that I mentioned before, Binance, BitMEX, FTX, none of these things were regulated. They didn't have the licenses that Hashkey did. Then in 2022, as there was a downturn caused by the Terra Luna, FTX and collapses and so on, we saw a real flight to quality. Previously, there was maybe a trend in the industry not to be licensed until you absolutely had to, or it was okay not to be. now we're increasingly clients are asking, if not, why not, with respect to licenses. People are much less likely or willing to do business with unlicensed entities. The flip side of that is there's been much more regulatory clarity, which is a good thing. Previously, if you talk to regulators, and I'm not just talking about Hong Kong, they would make very broad statements, but then they would invite you to speak to them on a closed-door basis about a particular project, and then they would make a decision based on that project. Now we're seeing much clearer regulations that are open for everybody to see, which makes it much easier for people to decide whether or not to launch projects and how to do so. And so the corollary of that is it's led to much more investment grade offers from sophisticated issuers, which we think is obviously a good thing for regulated business such as HashKey. And we see a resulting demand for an end-to-end, fully licensed route to market, which we can offer. So we have the full set of licenses. So we have as I said, a broker-dealer license, advising on securities license, a Type 7, which is operating an exchange, and a 9, which is an asset management license, and then TCSP, which is a trust and company services provider license, which means essentially custody services. Now, interestingly, that TCSP license is not actually doesn't actually have a virtual assets knowledge component, whereas the others, which are issued by the SFC, do. And I'll go into that in a little bit more detail now. So now I thought I'd talk about where we're going. So we've talked about what has occurred in Hong Kong, what the effects have been on HashKey, and then now I'm going to discuss what I think a good framework should have. Now, HashKey has these licenses in Hong Kong. We also hold licenses in Singapore, Japan, and Bermuda. So we've seen a few different regulatory regimes, for better and worse. So we're not wedded to one over another, but we have seen different approaches from different regulators. So when I say know thyself, and to consider a jurisdiction's unique selling proposition, it's important to think about what your jurisdiction actually has and why people would come to do business in your jurisdiction. And I think there's going to be sort of a bifurcation in terms of regimes. In a place like Hong Kong, it's well known as a financial services hub. You know, it's got legal precedent, common law system. It's well known as a place to do business. Now, its laws are well understood by lawyers, and that's a good thing. Whereas you'd have other jurisdictions, for example, that didn't necessarily have that background, like a VARA in Dubai, and they've probably seen this as an opportunity to design a more crypto-native based regulatory system. So I think it's important to think about where you're coming from and why people would or would not want to do business under your regime. The second thing is to understand regulators' limits of authority and how and why they need to cooperate. So if you were listening to the slides that I gave in the first part of this presentation, you would have seen the SFC, the HKMA, FSTB, Customs and Excise, and Companies Registry. Now, that's because Hong Kong is the way it is. So the SFC is the securities regulator, HKMA is a monetary and banking regulator, FSTB is Financial Treasury Bureau, Customs and Excise covers AML, and Companies Registry covers custody. So there's a lot of different people that regulate virtual assets in Hong Kong in one way or another. Whereas, say, in Singapore, you just have the Monetary Authority of Singapore, which just covers everything, right? In Japan, you have the FSA, similar sort of regulator. So if you're designing something, you need to actually work out what a regulator can and can't do, so that it's clear to stakeholders who they have to deal with, and also for regulators, so they make sure that they're not rolling out regulations that don't actually apply to them. The next thing is to consult widely with the industry and the general public. There's no point rolling out a regime if people either don't understand it or don't like the rules that you're rolling out. Next, you probably should ensure that regulators are constantly accessible. In something like Web3, which is changing all the time, you need to make sure that your laws and regulations are fit for purpose. And this goes hand in hand with that. You need to balance investor protection, which is all well and good, with fostering entrepreneurial innovation. Because if you go too far in one way, you are either endangering the public. You go too far the other way, you won't have any business. And this follows then that you don't want to have. I mean, business hates uncertainty. If your approval regime or your licensing regime is too uncertain, or it's subject to too much of a dead hand of regulation, it will really drive away business, both in terms of investors and issuers. We would advocate a freedom within boundaries approach. So make the initial licensing process more rigorous, do all of the DD you need to do, but then once you've given a license to somebody, you should trust them and ensure that they can do business using that license. So 3 things in conclusion. So we see that regulators are increasingly accepting the prominence of virtual assets. The future is regulated. We do think it's a one-way street. We don't think that things are suddenly going to become less regulated. And lastly, a regulatory framework is always a work in progress, particularly for something like Web3, where it moves so quickly, and there are new developments coming in all the time. Regulators are always going to be somewhat behind the curve, but you have to ensure that they do talk to the public and other stakeholders as much as possible so that the regulations are fit for purpose. Right, thank you very much.
Thank you very much, Jonathan. I'm going to move on now to invite Simon Mills, the lead author of the report, to make a presentation to us. Simon, the floor is yours.
Good morning, ladies and gentlemen. My name's Simon Mills. I was the lead author on this report, which was commissioned by Hong Kong's Financial Services Development Council, and I've been asked to give you a helicopter view of the key findings and recommendations. And I think perhaps the best place to start is a definition of what we actually mean by Web3. Web 1 was known as the static web, dates back to the earliest days of the World Wide Web, and websites were accessed from desktop computers, had very limited user interaction through either forms or very primitive fora. Web 2 is known as the social web. It's the web that we use today, and it's characterized by dynamic interactive websites and a torrent of user-generated content. Now, Web 3 is known as the semantic web or the decentralized web. Semantics is the study of meaning in language, and in this context, it actually refers to making web content more understandable by machines. In other words, making data more intelligent, interconnected, and decentralized. So, why is this important? Well, this new web architecture has the potential to enable a transformation in the way that financial services can be delivered, decentralizing and eliminating intermediaries and centralized exchanges, reducing transaction costs, greatly enhancing security and anonymity, lowering barriers to entry, and potentially reshaping financial services to be more inclusive and equitable. Next slide, please. So everybody wants a slice of decentralized pie, or DeFi, as it's known to the cognoscenti. Businesses want it because it represents new products and services, as well as massive cost savings and enhanced profit margins. And policy makers want it because DeFi is likely to be an area of significant competitive advantage to financial centers who are effective in attracting this business, and of course the entrepreneurs who are going to drive growth in this area. So, who are the organizations who are at the coalface forging a new future for financial services? Well, although market incumbents are dabbling in this field, they are very heavily invested in the very relationships and infrastructure that DeFi is likely to sweep away. So most of the truly cutting edge work tends to be driven by industry outsiders or disruptors. Next slide, please. All of this presents regulators with a challenge. Strong and effective regulation is important. Regulators are the last line of defense. Market integrity must be protected, consumers must be protected, and broader economic harm must be prevented. The vitally important role that regulators must play was underlined in the wake of the 2008 global financial crisis, when regulators were found wanting. Policymakers were determined that this should not happen again. Now, DeFi and Web3 certainly presents new risks and enhances old ones, AML and KYC being a case in point. This technology is by its nature supranational and hyperconnected, so problems could spread very quickly. And it's important to remember that these new firms are not part of the established order. They don't have reputations to protect. Their offices may not even have a financial services background. And so, as such, they may not recognize moral hazards such as market manipulation or insider trading when they see them. And yet, these are the seeds from which a mighty forest may grow, if only they could be nurtured, guided, and when necessary, pruned. Policymakers are demanding stability, but policymakers are also demanding growth. And to be successful, regulators must find a way to meet both of these potentially conflicting objectives. Next slide, please. So we know what effective regulation looks like. It should be independent, it should be trusted, it should be accountable and transparent, etc., etc., etc. But how does this actually manifest when trying to encourage innovation whilst protecting markets, consumers, and economic systems? Next slide, please. Well, there are three main approaches the regulator can take when it comes to managing innovation within their jurisdiction. The first is a formal structured approach, which is very restrictive on innovation until a better understanding of it and the risks that it poses to systems and consumers has been gained. To paraphrase, it's very much a case of innovation being for other people, and only when a technology or product has had a chance to bed in and prove that it's not going to catch fire and burn the markets down, then you actually consider allowing it in. Now, diametrically opposed to this is the laissez-faire approach, which positively welcomes small-scale innovation right up until the point when it becomes large-scale innovation or catches fire in a particularly spectacular way. At which point there's a wide-scale and potentially disruptive crackdown, which establishes a legal framework that addresses the identified issues. And finally, there is ad hoc licensing, which licenses innovation within certain boundaries subject to testing, data collection, reporting, restrictions, etc. Now, I've also included sandboxes on this list, not because they're a regulatory approach, they're not, they're a tool, but because it is demonstrably the most widely used method to provide a controlled environment where businesses can test models under a temporary relaxation of certain regulations. Unlike the laissez-faire approach, sandboxes are time limited and come with structured and standardized safeguards, allowing safe experimentation within a regulatory framework. Next slide, please. So enough beating around the bush. We were commissioned to have a look at how Hong Kong was delivering on its aims to encourage innovation whilst maintaining a reputation as a highly respected and rigorously regulated global financial centre. We did this through comparative analysis of data collected through the Global Financial Centres Index, through extensive literature review, and through discursive interviews with local industry experts. Our report shows that in an era where digital innovation is rapidly reshaping financial markets, Hong Kong's approach to regulating the Web3 and FinTech sectors provides a reference point for the global community. And it's got hard-won lessons that could be applied beneficially across different regulatory environments. Hong Kong's experience with Web3 regulation provides quite a robust case study for other regions seeking to foster innovations whilst ensuring market stability. And I think the single most important lesson that policymakers and other jurisdictions should take away is the need for predictability in policy outcomes. Within Hong Kong, market participants universally praise its regulatory roadmap, which serves as a model for reducing policy uncertainty and supporting strategic growth across diverse financial landscapes. And this approach helps attract global talent and solidifies the island's status as an innovative hub, a goal that many other governments share. Now, Hong Kong has taken an early lead in developing Web3 and FinTech markets, which as areas of economic activity, which are very likely to increase significantly in importance over the coming decade. For other jurisdictions seeking to emulate this success, it's worth remembering that regulatory systems are going to face significant stresses as a result of the development of new DeFi architectures, and it's essential that they adapt to encompass these innovations. This is going to require additional resources and training for regulators, as no matter what approach is taken in delivering regulatory oversight, the emphasis must be on the risk management of products and services and the governance of the organizations concerned. Customers need to be taken along on this journey, as informed consumers need information in order to actually understand how services function and how their own risk should be effectively managed. Finally, it's worth remembering DeFi is a transnational and transjurisdictional business, and regulators must consider their responsibilities as to how they can coordinate the responses both domestically and internationally. Now, I'm conscious that we have run out of time. There is, of course, a great deal more detail in the report itself, which I urge you to download and read. But I'll hand you back over to Mike now. Mike, thank you.
Thank you very much, Simon. We do have a question, I think, probably for Simon. Just asking, Chris David's asking, what do we mean by digital platforms? Everything now is done through digital systems, but what are the defining things which make digital platforms different from others?
Right. Well, I think that you're quite right. Everything is done electronically nowadays, but I think in this context, we're very much talking about blockchain-enabled transactions, and it is worth disambiguating this. We're not just talking about cryptocurrencies. We are talking about the use of blockchain enabled transactions and end-to-end business. So smart contracts, the tokenization of real world assets, etc. It moves so far beyond the current use of electronic business that it has the potential to completely transform financial services. Quick plug for our own organization, Mike. There is a huge wealth of literature on the digitization of business on the Long Finance website, and I would urge you to have a look there.
Thank you very much. Just Sean, Jonathan, Simon, at the moment I can't see you. Just could you check whether your cameras are on? And if you can turn on, that would be great. I'm just turning over to another question from Dan Feeney, who just commented that Verifin estimated last year we lost $3.1 trillion to fraud and money laundering from banking systems, and asking, shouldn't DeFi and stablecoin adoption alleviate this growing systemic failure, as he puts it, over legacy banks? Sean, you might have some thoughts on that.
Yeah, that's a great question. I mean, let me qualify one thing first. When we talk about stablecoin these days, especially regulated stablecoins, we are predominantly talking about fiat reference stablecoins. That means the stablecoin is indeed pegged to an underlying currency, whether that's US dollar or Hong Kong dollar or any other currency. And then it does have an actual collateral that's sitting in a regulated entity, typically a bank. So in actual fact, a regulated stablecoin is very much you can think about it as a regulated bridge between the traditional finance world, but then in a way to tokenize money and put it on the blockchain. The question then becomes, why do you want to do that? And the answer is there are increasingly more so in terms of tokenized assets that are being originated on the blockchain, and thereby you need a currency on chain to be able to transact. Now, the questions about the stability in the banking system and whether it will have a realistic impact to the stablecoin ecosystem. If we're talking about fiat reference stablecoin, we do need both sides of the ecosystem to be robust because the underlying collateral at the end of the day are sitting in banks. Now, naturally, in proper risk management and diversification perspective, especially given what has happened to Silicon Valley Bank and a few other banking institutions in the US that a few years ago used to support the majority of the stablecoin projects, it is very prudent to have a diverse banking partner network, as well as proper risk management procedures in place to ensure that connectivity is still kept in the most robust manner. But to say fiat reference stablecoin is completely disjointed away from traditional finance and thereby shielded away from potential instability in the financial markets, that would be an incorrect statement. It is very much intertwined, but I see it more as a regulated bridge rather than something completely on the side.
Thank you
If
so
I
much.
could, if I could just add to that, I think the
Simon,
question
sorry,
was.
we're really short of time, I'm afraid. I've got a lot of questions to come through, so I'm going to move on if that's okay. Christopher Turnbull's asked a couple of questions about whether we can get a sense of the metrics, the sort of relative size of the various types of digital currencies. You know, how big a stable coin compared with Bitcoin, compared with fiat currencies, and the relative size of digital asset markets, and how that plays into regulation. And I just wondered, Jonathan, if you had some sense of the relative size of markets and whether regulators are using those kind of metrics on size to take a risk-based approach to what's going on.
I don't think the size really plays into the regulators' calculations as to whether as to how they regulate. I think it's more based on investor protection. So no matter the size of something, I think that they're going to look at the actual nature of the product first and foremost.
That's great. Do any of you have a view about the size of the different markets?
Maybe I'll chime in on the stablecoin part very quickly. It's roughly about $170+ billion worth of stablecoin out there today. Predominantly, I think 99% are denominated in US dollars, although increasingly more non-US dollar based stablecoins are coming into the market. But the market size roughly about 170 billion at the moment. 350 million users, by the way. I just want to add that.
Thank you so much. John Taylor's asked a question about when abuses occur in sort of Web3 products, what approaches are regulators taking to enforcement? Who should be penalised when things go wrong? Simon, do you have any thoughts about this?
Yes, and I think this covers questions about almost any aspect of Web3 products. If it walks like a duck and it quacks like a duck, it's a duck, and regulators need to regulate the products and the risks associated with products. They're concerned with consumer protection, they're concerned with market protection. No matter what label you put on it, whether it's Web3, whether it's crypto stabilized, ETF, EFT, etc., it doesn't matter. Regulators have a job to do, and hiding behind the fact you're a crypto organization doesn't cut it. The regulator must apply the regulations. So if an organization is in breach of those regulations, it will be fined, its officers will be punished. That's just the way it is. It doesn't matter what you're selling, you have to abide by the rules.
Thank you so much. I've only got time for one last question, and those of you who haven't had your questions answered, we will put you in touch with the speakers. And Christopher Turnbull again, Simon, you mentioned that decentralization and DeFi would reduce transaction costs, certainly for business. But just referring to the energy cost of, for example, Bitcoin, is the overall cost of running digital services taken into account when you look at the cost of running digitalized systems?
Things have certainly improved a great deal since the early days of cryptocurrencies. If you look at Ethereum, Ethereum has now changed the way in which proof of stake is is generated, so it is an order of magnitude less energy intensive than it was, and I believe that it's likely that that Bitcoin's going to go the same way. But energy is a significant consideration.
Well, thank you very much indeed. I'm afraid we have run out of time. Just to say, we've got a few events coming up this evening. For those of you in London, we've got a mixer talking about carbon trading. Later on this morning, we have Bake for Ukraine, a webinar looking at a particular project based in Ukraine. Tomorrow, the launch of the Global Green Finance Index 14, and on Friday, a session on glass, the world's most important material. So plenty of content coming up. And do keep an eye on the website for future events. Just remains for me to thank very much you for your attendance, for your engagement, for your questions, and to give huge thanks to Simon Mills, Sean Lee, and Jonathan Gill. It's been a really inspiring session and really good to get a perspective, a worldwide perspective, on the future of DeFi and the regulation of digital processes. So thank you very much, everyone. We'll see you again shortly.